All right, good morning, everybody. It's a Friday. Hey, why don't we do some trading and investing? Hey, why not? So, welcome to QuantBox Live. This is where we get our macro on. Our value proposition here at QuantBox is our AI-driven analysis of sentiment, inflation, employment, GDP, technical trends, open trade positioning, and seasonality. Uncover the best fundamental opportunities across the global markets. But we have expanded and got bigger and smarter with our analysis. And we also now have real time and very long term market sentiment. What does that mean? Well, I can tell you where the money is going right now, today, this week, and this month, as far as risk on or risk off. But I can also show you where central banks are telling us interest rates and inflation will be 18 months from now, which is projections that way out into the future. So, oh my goodness, QuantBox is amazing. My name is Wayne McDonald. I'm a Harvard educated macroeconomist, and I created QuantBox because I've been using macroeconomic data to assess global trends of capital flows. And if you're a foreign exchange trader, that's what it's all about. But then that impacts other markets like commodities, gold and oil, for sure. The stock market, do you think the stock market cares where money is flowing? Yeah, of course. So it's right. I look at everything as Newtonian physics. It's like clockwork. So all these trends impact the things we like to trade. Very cool. So, anyways, if you're watching this video on YouTube, you're watching it many hours delayed. Why don't you swing by quantbox.co? Take a trial, check it out. $8 for your first week. You can see all the pretty colors and see everything that you're probably missing in your trading. Very cool. Or you could just waste time, years trying to do it yourself. Or even worse, just keep doing what you're doing. Anyways, let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus in the long term, never risk money you cannot afford to lose. Let's log into the database. Cool. And by the way, because you can see it's showing me the upgrade option here. This is right. This is set up as a basic membership. Although I have pro access because I own the whole thing. So, anyways, it helps. Yeah, yeah, for sure. By the way, I have been so busy that about 3 weeks ago, I unlocked about 6 or 7 upgrades to the pro account, and I haven't even had time to unlock more upgrades that have already been done. Like, what do I do all day? Gee whiz. So I got to find time to open some of these upgrades and give them to you, huh? Even if I don't tell you. Some of these things are unlocked and I haven't even told you that they're there. So explore, my friend, explore. Anywho, let me zoom in. And then I'd like to go off screen, off Quant Box today a little bit and just do a little macro on US fundamentals. Is that, I think that's appropriate for QuantBox. We can do it. Anyways, let's take a look at the markets right now. Bitcoin's still under 30,000. Euro dollar's still about 110. S&P 500 still below 45. Look, nothing's happened. Okay, gold's still at 1950. Now, is it actually 1950? Remember, it was stuck yesterday at 1955, and so it's like it's 1922. I've yelled multiple times at the developer, and I think that's correct, right? But let's just check that. Let's check that. I got to go over here. What is gold? Come on, gold, please be right. XAU 1970. All right, good. I get to yell at people again. Okay. I will send yet another email. Yeah, sorry. Gee whiz. So it must be a data provider glitching on us. Well, someone's got to fix it. That's all I know. So, anyways, gold. This is get your actual analysis from not from just the headline. Go to the gold page. Anyways, yield on the 10-year still above 4. That's interesting. We were at 3.99 earlier in the week. And things are changing, though. Things are changing. Um, right now, today, things are mixed. Okay. And how do we get to that? Well, we get to that many different ways, but how would you analyze today's scatter plot if you were to try to get the average price, the mean of all these assets? It kind of what? Like that? Yeah, with some big outliers. And then what? You'd want to calculate the variance from that. This is really high. That's really high. Probably take those out. So those are outliers. You don't want to count them. So the highest low is -5. Highest high is 6. So you'd probably get like you with a 95% confidence level. The trend would probably look like a little skewed, a little higher to the upside. So what does this all mean? Slightly positive. It's slightly positive, not amazing day. It's been flat, so you're like, okay, okay, just ever so slightly, maybe, how would you say, maybe risk on? Well, then let's look further. What seems to be the trend for things right now? Pound is up, pound is up, pound is up, pound is up. It's just the reverse, so that's why that one's negative. Pound is up. Is there any particular reason pound is up? Pound is up. Pound is up. Yeah, GDP was good today, surprisingly. Um, I wonder if it's accurate. uh, yeah, well, good job, UK. Okay, good job. Slap you in the butt, UK. Good job. Slap. I'm sure they love that in England. Anyways, good job. Um, Yeah, things have been tough there, but inflation is trying to come down. Very cool. And productivity, well, what I like to say is anything better than zero. So good job. So, anyways, that's a positive for the UK. Although, what the heck is that all about? Huh? The interesting thing is, it's got a score of 0, but it's way down today. Huh. So, what does that mean? Why would that be down and the currency is up? It's got good news. It's inflationary. It's got positive GDP. Well, maybe the Bank of England has to raise higher. It almost killed the patient. Okay. So, anyways, another round of raising interest rates and that kills profitability. Okay. You remember the simple math that goes into that logic, right? It's not quite the exact math, but it is the right to do. So let me see if I remember. The expected return of a stock is equal to the risk-free rate of return minus the beta of the expected return. No, this is a plus. Okay. Expected return of the market minus the risk-free rate of return, because that's your opportunity cost. I think that's it. See? For someone that's never seen this. See? Well, enough said. Enough said. See? That I just proved it with my model that shows that in this scenario, if all these if the pound is strong in reaction to a positive GDP print, the FTSE will fall. Now, if I were to explain it to me, Lucy. Okay, let me explain it to you. What we're talking about here, it's not actually interest rates, but you can pretend it's interest rates, very similar. It's the cost of borrowing money, essentially. So it could be some sort of interest rate at your bank. It could be the yield on the gilt, whatever. And that when this goes up, okay, the value of these assets fall. Now, to make this proper math, I'd probably have to rearrange this because we're not actually interested in the expected return of a stock. We're concerned with the expected return of the market, but nonetheless, go with me. They are related. Okay. So, anyways, if it costs more money for British companies to borrow, because when you're a business, you have to borrow all the time. Your customers pay you maybe every 3 months, every 6 months. Maybe they'll pay you next year. Okay. It's sort of like a farmer selling wheat in January in the United States, but the wheat's not going to be available until September. So that's why, you would borrow and then you get it back later, and it's a cash flow issue. So it's normal for a business to borrow money. So if you have to pay more money to borrow that money, then your profitability will be less. It comes out of your profit margin. You'll make less profit. So, anyways, the FTSE's down on the idea that the Bank of England can raise interest rates more if they want to. That would make British companies less profitable. The price falls. Good news was bad news. Anywho, let's take a look at risk gauges. There's been a change in the world today. Things are back to risk off. Not in the moment, but it's just creeped in to -2, and then monthly is now -5. So it's back. So remember, this was all risk on 5 weeks ago. Everything was risk on. And we were anticipating a shift from risk on to mixed to slightly bearish. We've been mixed basically for a week and a half now, 2 weeks. And now in the last, let's say, 4 or 5 days, we've gone from risk off to mixed to risk off again. So far, so good. This is following our seasonality tools. Right, our global seasonality is working as expected, I would say. Okay, and you're like, Wayne, what do you mean by seasonality? Under economic analysis, you can click something called seasonality, and you can do seasonality for like the UK stock market, for example. Okay, you can see there's a bit of a disconnect this year. This is complicated, the economic conditions we're in. But if you go to January, QuantBox said the FTSE would be up, and it was up. But then QuantBox says very often it comes down. Yeah, well, it still went up. Oh, but then March was supposed to be down, and it was down. And then April, it was supposed to be flat, and it was flat. And then May was supposed to be up, but it was way down. Whoa, 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 whoa. Okay, look, obviously, this isn't an average year. Would you consider our market conditions an average year? No, but there's still normality. And you can see there's been kind of disconnects. Like it hasn't been, like some of these are okay, and then some are off. But at least now you can observe normality. I wouldn't look at like I wouldn't say September's down, so you're going to sell it hard now. Like, no, well, that's not really the logic. It's not about betting, but it's understanding what the normal capital flows are. Okay. But if we're in a risk on period for the FTSE, it's not abnormal this time of year. If we're going to risk off, it's not abnormal. And you're like, oh, well, that's interesting. Do you just have stock market stuff? No. Oh, look at this. This is interesting. The developers made a mistake. Good. In our favor. It's sort of like playing Monopoly. Developers made a mistake in your favor. Collect $150. Yeah. And you're like, wow, do I get to go past go? No. No. Oh, interesting. Oh, they accidentally took VIX. Shh, don't tell anybody. All right, cool. Freebie, Knuckles. So, yeah, I planned this out long ago. This is part of the strategy at QuantBox. Now you have VIX. You're welcome. All right. What is VIX? This is the market buying options on the S&P 500 to protect them from the downside. This is an insurance policy. If VIX is going up, billion-dollar hedge fund managers are worried that their portfolio is going to lose value. So they just buy options. Don't worry about it. Offset the risk. Okay. So down is risk on, up is risk off. Look at this. August, VIX is expected to go up and is way up. Isn't that interesting? Okay. So, like, this was right, wrong, right, right. The gray bar is actually what happened. Correct, 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 correct. Look, yeah, it was only off 1 month this year. Pretty nice. Why is this important? Well, in this period here, maybe even when it kind of starts coming back down, okay, it's not just the headline I'm looking at the trend. Somewhere in here, I might actually employ a strategy that would benefit from falling VIX, falling volatility. I can actually trade the vol. So if I thought somewhere around the September, October, November period, volatility will fall in the United States stock market, I can carry this out with the strategy and make money. Also, think of this inversely. If if hedge fund managers are not buying insurance to protect them from the downside, you could assume the stock market's going up. Why would you buy in downside insurance if it's going up? So VIX down, S&P 500 up, or let's do Dow. No, we can do. Nah, let's do Dow. Let's do Dow just for fun. Okay. Yeah. Cool. So you see here, VIX was falling. QuantBox says, get ready in September. By November, you should be tickled pink. Okay. By December, you should be cashing out, going on vacation early in a beautifully warm tropical place, and get a sunburn um, to make your cousins jealous. Denise, are you suntanned? Yeah, I was in the Caribbean again. It's it's a burden. Now I'll look terrible in all my Christmas pictures with the sunburn. It's a burden. Your cousins will hate you. And that's what it's all about. Anyways, and then what? Yeah. cash out here. The peaks is here. Cash out somewhere in December. Could see December doesn't know. This could be what, the 12th of December, and you're already out. That's all we know is there's a peak in there. And then what? Yeah. Okay. See, when you go this way, that's a buy. You've heard me teach you that. And then you've heard me teach you this, right? How many times have you heard me buy in May and go away? I love it because people are like, Wayne, you got it wrong. What everybody tells you is sell in May and go away. I'm like, yeah, do you see that giant that giant candle of bulls making money? Well, that's me. And the cliche does the opposite, right? So, anyways, but you can see what it comes from, huh? From here to here is probably people leaving, and then from there to there, yeah, one more move. Anyways, look at QuantBox. It's amazing to have this kind of detail, huh? So, anyways, we have that for everything. Okay. Ooh, do you want to know Bitcoin? Yeah, pay the money. All right. Notice Dixie's on there too. Somebody's really making mistakes. Do you notice that? We have Dixie, VIX. Yeah, we have the data, but someone's taken it. There's Dixie. Someone's taken it because we're using this information for our calculations, and someone's just like threw it in there. So cool. That's really neat. All right, so let's uh let's get off of here. Let's get off the charts, which is the name of my blog I haven't ever done. Where did I want to go? By the way, I came up with another idea for a blog, or not a blog, a podcast. Sorry. How about this one? Does that make sense? Wouldn't that be a good name for a podcast? Sense, like as in money. Does that make sense? I don't know if I'd want to do economics. I thought it'd be cool to just travel the world and talk to people about how they make their money. Right? Like, let's go to South Africa and visit Raymond in a chromium mine. How many people would like to see a chromium mine? Like, you know what is chromium? It's the thing that makes stainless steel stainless. And somebody has to dig it out of the ground and then sell it. Let's learn everything we can about it, right? And then ask the ultimate question. Does that make sense? How do you make money out of that? What goes into making money out of chromium mining, huh? Anyways. All right. So this is the San Francisco Fed. They wrote a letter I don't know, recently, the other day. And then we've had CPI, and I talked about PPI yesterday in quite some length. I wanted to break down this idea that there's inflation, okay? And then there's measures of inflation. So you have your headline, okay? And then you have core. And now we have something called SuperCore, but almost nobody understands that anymore because they use the media to get their information instead of understanding it. Okay, cool. All right, so this is a new measure announced by Jay Powell 3 months ago, maybe. He actually said they now look at SuperCore. All right, so inflation. There's three different measures now. Okay, headline is the one you're familiar with, the one that gets reported. It's not actually used by the Fed. They use PCE, not CPI, but whatever. So we'll call this CPI. Let's further label this properly. Okay. All right. CPI, consumer price inflation. Inflation is the headline number, it's the price of everything. Then we look at core. When we strip out some of the data, why do we strip out some of the data? A lot of people get mad. Well, because the Fed are a bunch of liars and they're cheating us. They're not in tune with reality. Well, they are in tune with reality. They're doing their job. Jim's like, too volatile. Yeah, but that's not actually the reason. The reason is, let's say oil prices have doubled. What are the chances that oil prices have doubled because of a policy the Fed made? Or if oil doubles, can the Fed enact a policy to address it? No, there's a shortage of oil or there's crazy demand. But it has nothing to do with the Fed, nor can the Fed actually do anything about it. If chicken prices are through the roof, that has nothing to do with the Fed. What are they going to do? Jack up interest rates to address high chicken prices? No, the chickens got sick and they all died. So prices for chicken is up. It's not a monetary policy issue, right? So that's kind of the real. But of course, these econ nerds can't say it that clearly. So it's very misunderstood. And when something's misunderstood, usually you get a conspiracy theory around it, trying to understand why you would strip it out. Okay. So the Fed can't do anything about those volatile um, resources, right? And then we have something called SuperCore. And SuperCore now is because we're trying to identify how sticky some of the prices are, because the Fed wants to know of the lagging forms of inflation, which ones are lagging and when are they going to pick up. So you kind of like observe the black hole by looking at how light is distorted. You're kind of trying to figure out the different types of inflation, maybe not by direct observation, but by indirect observation. So you try to figure out um, the other components of the headline inflation, which ones are coming down and which ones are not coming down, and of the ones that are not coming down, when will they start coming down? So you're breaking it out from white light into a spectrum and analyzing each color. That's the idea. Okay. And so, in this case, the prism is our mathematical analysis. So light comes in, hits a prism. Okay. Light comes in, and what happens? Well, that was supposed to be pink. Okay. And we're trying to measure different forms of inflation, right? Woo, don't click that button. Okay, cool. So that's what we're trying to do. Headline inflation in, split it up, and look at different types of inflation and find some of it's coming up, some of it's coming down. Cool. So anyways, that's where we are. And here's an attempt here. Let me open this up in a new tab. Again, research presented just the other day by the San Francisco Fed. Okay, here's what I want to point out. Use the highlighter. This is what we're looking at. This is rent equivalent. This is actual rents or mortgages. Because if you own your own house, you're still paying rent to your house. Okay. And look at that. That's a sticky thing. Rents come down with the market, but it's slow. Like, for example, how do you sell sweaters in July if you're in the northern hemisphere? You just put them on sale. Done. Right? Like, how hard was that? In fact, you don't want to wait that long, so you put the sweaters on sale in February, March when it's still cold. And you get rid of that excess inventory and just cut prices, and it's easy. Um, in an apartment building scenario, the landlord just doesn't contact all the renters and say, "Hey, guess what? I'm cutting your rent by 10%." No, they wait for you to move out, and then the new tenant is paying slightly less, and then someone else moves out, and then they replace them, and that new tenant is paying a little less. Okay. If you never sell your house, okay, then your owner equivalent of rent doesn't change. By the way, sorry, I think it's this ghee I'm drinking. Too much animal fat in my coffee. Me. In sooth, I know not why I am so sad. 20 dwarves, 20 dwarves. All right, I'm trying to get there. So, nonetheless, guess what? This last, okay, this is what the Fed was calling SuperCore, because they're trying to say, well, gee whiz, sorry. When is this last component of inflation coming down? And what the San Francisco Fed pointed out is that it looks like it's starting to come down. Things like the case Schiller is showing prices coming down in various parts of the United States, not equally, some places are not, but rents are falling in New York City. So you only need $5,000 a month to live in a doghouse with with no parking for your car, but you can't afford a car anyway, so it doesn't matter. Not New York City. You make nearly $1 million a year and you're broke. Yeah, New York. New York. So, anyways, and then they take this a little further and they do some linear projections. Let me do this. Okay, this is just the calculation, case Schiller, core logic, all that kind of stuff. Yeah. And then let me get to the next one. There we go. They have two versions of this. I don't know if it matters one way or the other. Let's just open it up. The conclusion is the same. So they do a linear projection, and actually they break this down into, they take that last one, the case Schiller numbers and the core logic numbers and all these different numbers, and then they try to break them down by region, and then they try to take an average of that region, and then you calculate the variance of this region. Yeah. And then from that, remember, you take the square root of the variance, remember, and you'll get a confidence level of 95%. Okay. And so what they're taking that variance around the United States and calculating confidence levels, and you get this kind of a standard deviation. So you notice it's tighter now. This is the near term projection, and then you look later out. Why is it narrow here and wide over here? Well, right now, in some places of the United States, rents are falling and over owner equivalent rents are falling. So housing prices are falling. Are they falling equally around the United States? No. Some are falling precipitously and some are not falling at all. People are moving out of Detroit and moving to Austin, Texas, for example, or they're moving out of Milpitas. Shout out to Milpitas. Yeah, that's where the old Tesla plant was, and before that, the Numi plant. But anyways, so they're leaving California and they're moving to Austin, Texas, right? So maybe in Milpitas, housing prices are falling, but maybe they're actually rising in Austin, right? Now, that process is just starting, as we just saw from the last this rollover part. This process here has just begun, and so if that trend continues, then the places that are selling are going to sell, and the places that are sticky are going to come down a little bit. But nonetheless, it's changing. And then you take the mean of that, and that's just your simple basic linear projection with a rise over run. That's a negative integer. Lovely. What does this mean? CPI is expected to fall in the future. That core stuff that's been holding us up will start dragging this down over the next year. CPI will fall. It's been a lagging part of the indicator that keeps inflation persistently high. But according to this research by the San Francisco Fed, let me go back to that first chart. Okay, there's new disinflationary pressures in our math now if this continues. So pay attention to core logic and case Schiller. Now, Schiller is a Nobel Prize winning economist from Yale. He's nerdy as heck, but he's a superstar in the econ world, and he is a smart dude. And he doesn't do any work in that case. Schiller Case does all the work, and I'm pretty sure Robert Schiller, makes all the money and gets all the fame. It's a great deal. Yeah, but Case wouldn't have a business if he didn't have the Schiller name on the brand. So hey, whatever. Okay. So anyways, you maybe pay attention to that Case Schiller, and now you can thread this in your research, or at least in your discussions with your potential investors, and you can talk about SuperCore. And your potential investor is going to say, What's SuperCore? I understand core, but what's SuperCore?" Oh, and now you have this whole speech about how Jay Powell brought it up in the March Fed meeting. And what they're trying to do is, like a prism, separate all the different forces of inflation inside the CPI to get rid of the stuff that doesn't get impacted by monetary policy. And what they're trying to do is look at owner equivalent rents, which are lagging, they're sticky levels of inflation, but we want to use that as a predictive indicator for inflation pressures in the future. And right now, when you look at that owner equivalent rents, it seems to be coming down, and the projections show that blah, 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 blah. Cool. Now at least you sound smart. And the rule about managing money, you only have to be 1% smarter than your client. Cool. So that's that. That's QuantBox for today. There's your food for thought. Okay. Should be interesting. Still a little bit risk off. We were flat there for a while. It looks like things are coming back to a risk off tone. Okay. Longer term, VIX is going up. It's a little mixed on the shorter term. So it's not easy. It's not clean. It's just slightly, ever so slightly bearish on the weekly. Nothing's happening today. In fact, the way I measured it using the scatter plot, which is a completely different math than what's going on here, there's just slightly bullishness. All of this said, what's happening is seasonal and expected. That's good because we want to be confident to be bulls when the bullishness comes back. But this also says caution, caution, caution. So don't do something stupid today and lose a lot of money. It's completely unwarranted and would be a massive mistake on your part. You're not analyzing risk and opportunity properly. And if you just throw down money today, like it's just the same as the middle of March and middle of November, you're like, oh, it's middle of August. What's the difference? Then you don't know. And you should know because now you have the information in front of you. So be cautious, be smart, be informed, do the right thing, do the best you can do. And with that, I wish you success and and admiration by everybody. Peace on earth. May the pips be with you. May your profits be above average. If I don't see you later today, have a wonderful weekend. See you next week. Cheers.